Alright, so budgeting. So the plan for accounting is that it's quite difficult to make examples. So we straight move to past paper questions, the tough ones for each topic, perhaps 2 to 3 for each topic. So I have this question over here for budgeting. It's from October-November 14, variant 3, paper 4, and it's called Seko Limited. Alright, so I have the financial statements of Seko Limited over here. The year ending is 30th June 2014. Now, I have revenue, cost of goods sold, gross profit, all the operating expenses, and finally the profit for the year. Right. Then we're also given the statement of financial position for this. Assets, plant and machinery, motor vehicles, inventory, receivables, cash and cash equivalents, 200,000 ordinary shares and retained earnings, no share premium, no revaluation reserve, trade payables, accrued salaries, and that's it. Alright, so let's see. Okay, so Seko Limited plans to expand its business in the following year and would like to prepare a budget for the year ending 30th June 2015. Alright, so we'll deal with each adjustment, each point one at a time. So let's say additional plant and machinery 220,000 and 130,000 are to be purchased on 1st July 2014. Alright, so this means the start of the year because our year ended on 30th June 2014. Alright, to finance the non-current assets, a 4-year 10% loan of 100,000, a new issue of 250,000 ordinary shares of $1 each will be raised on the same day. The first payment of loan interest and capital will be made on 1st July 2015. That means in the next year. So interest payment, we can say that will be accrued for the year for the year July 14 to June 15. Alright, so additional machinery and plant and machinery 220,000. So additional plant and machinery, I add 220 over here, and then it says motor vehicles of 130,000. So motor vehicles of 130,000. Alright, then it says to finance the non-current assets, a 4-year 10% loan of 100,000. So previously there were no non-current liabilities, but now there will be a 10% loan of 100,000. Alright, that's, and a new issue of 250,000 ordinary shares at $1 each. So this means that the new shares will be issued at par. So the new issue of 250,000 each. So this will become 200 plus 250. Right. Sales volume is expected to rise by 60% and the selling price is expected to increase by 10%. Alright, so here's the thing. The sales volume will increase by 60% and then the price will increase by 10%. So you should not confuse this as a total increase or cumulative increase of 70%. It's basically an increase of 60% and 10%. So basically a 60% into 10%. So the sales were 3,000. So I'll do this on the next page over here. So 3,000 sales. They first increase by 1.6 and then they further increase by 10%. So 1.6 into 1.1 and you get your new sales, the budgeted sales, as 5280. Alright. Gross profit as a percentage of sales is expected to decrease by 40%. Alright, so if I look at this, the gross profit was 1350. So if I calculate the gross profit margin, I'll call this W2. So gross profit margin will be 1350 upon 3,000, and this is basically 45%. So this will go down by 40%. So 40% of 5280 will give me 2112. So this is my gross profit. So now that I know my gross profit, I can calculate my cost of sales. This will turn out to be 5280 minus 2112. So this will be 3168. Okay. So sales and purchases are expected to be made evenly during the year. All sales and purchases are on credit. The sales credit period will be 1 month, alright, and while the purchases credit period will be 2 months. So first I need to calculate my purchases. So I know my cost of sales, and I also know that in the next, let's do the fifth one as well. The closing inventory is expected to be 180,000. So I know my closing inventory. I know my opening inventory from the given balance sheet. That's 120. So I can easily calculate my purchases. So my purchases will be, you do the math and you get your purchases to be 3228. So those are your purchases. Now working 3, the calculation of trade payables and trade receivables. So trade receivables first. So all sales were on credit. So 5280 divided by 12, because it also says that sales occur evenly during the year. So 5280 divided by 12 is 440. So $440 a month is your sales. And it also says that the trade receivables, let me see the exact words. Yeah, they say that the sales credit period will be 1 month. So that means that a customer takes a month to pay back. So this means that from all the way to January to December, you will get payments for 11 months of sales. That means the only month that will be remaining will be the month of December. And in the month of December, we had a total of 440 sales. So this means that 440 will be your amount for trade receivables. For trade payables, though, trade payables is also occurs evenly during the year. So 3228 divided by 12 gives me 269 a month. But the creditors, the purchases credit period was 2 months. That means I take 2 months to pay back to the to pay back to the suppliers. This means that from January I'll make the payments till November. But I'll make the payments till November, and the payment that I'll make in November will be for the month of October and September. So this means that at the end of the year, that's June. I'll basically be making I'll basically be owing 2 months worth of purchases to the suppliers, because it's 2 month credit period. So 269 into 2 gives me my trade payables of 538. And sorry, I've been saying year end period is December. The year end period is June. 30th June 2015 is the closing date of closing date, is the closing year. Okay, then it says 2 salesmen will be employed to strengthen the selling activities. Apart from the total annual salaries of 120,000, the salesman will be entitled to a commission, 3% of gross sales, payable in July 2015. This means that the commission will be accrued, and a 5% of the profit of the year. Alright, so 5% profit of the year after charging the bonus. This is also payable in July 2015. This means this will also be accrued. Now it says 5% of the profit for the year, and we know that we are making a budget for a private limited company. It's basically we don't know if it's a public or private, but it's basically a company. And operational profit less financial charges gives you the profit for the year. So it's basically 5% of that. Alright, so for the commission, I'll do this on the next page. So for the commission, this is commission is 3% of gross sales. So 3% of 5280, and this turns out to be 158.4. And then I have the bonus. So bonus is 0.05x, where x is my profit for the year. Now, all other expenses are expected to increase by 5%. So basically, you multiply the current expenses by 1.05, or you figure out what 5% is and add it to the expenses, and then you just increase your expenses. So this one's easy. The next one, depreciation on non-current assets held at 30th June and will be charged 20% on the straight line basis. Alright, so 20% of the new cost. This will be 300 plus 220 for plant and machinery, and this will be 240 plus 130 for motor vehicles. So let's calculate the depreciation. So for plant and machinery, 20% of 520, this will be 104. Motor vehicles, 20% of 370, this will be 74. So you get your depreciation charge for the year. The last adjustment is no bad debts are anticipated. A provision for doubtful debts will be made at 2% of the trade receivables at the year end. So the trade receivables at the year end were 440. So I'll call this provision for doubtful debts. So 2% of 440 will give me 8.8. So we are done with all the adjustments, and I'll just make the income statement. So sales. So the sales will be 5280 less the cost of sales. The cost of sales I calculated to be 3168. So less 3168 gives me 2112 less operating expenses. So operating expenses, I've already done the math over here. So operating expenses will be 735 102.9, and then you just all the way you go down, add all the expenses. I've already done this stuff over here. So this will go all the way down to your salaries. For the salaries were 123, the commission was 158.4, and then 0.05x, that we still don't know. And then you get your operational profit. Operational profit is still unknown, and from the operational profit you subtract the loan interest of 10 as financial charges, and you get X. So basically X is your profit for the year, and we still have to find the bonus. So I've already done the math over here. You add all the expenses and you get the figure that you get is, for your operational expenses, you get 1748.7 plus 0.05x. This is your bonus. So basically 212, the gross profit, minus this and minus 10 for the interest, will give you X. Wait a minute, this is 3, this is not 4. Alright, so your X after calculation will turn out to be 346. So 346 is my profit for the year. So the bonus will be 0.05 of X. 5% of 346 is 17.3. So you fix it over here again. This shall be 17.3, right, and this over here will be 346. So this becomes, alright, so I did not write down all the operational expenses because it's just a waste of time. You just have to increase it by 5% and write them down. So this was the budgeted income statement, the profit of 346, and through that we calculated the bonus. Alright, so the next part is, we've done this one. The next part is prepare the budgeted bank account for the year ending 30th June 2015. So I'll just quickly add all the stuff that needs to be done. So the brought down for the year was 86. This was the opening balance. Now I received payments for 11 months. So 11 into I received payments for 11 months plus, so basically 11 months plus the trade receivables, the opening trade receivables. So 245 plus 11 into 440. This will give me 5085. Right. Then I got money from a loan of 10%. This will be 100, and an issue of shares. This will be 250. So these are all the receipts that I can find. Now I bought plant and machinery worth 220,000. Then I purchased motor vehicle for 130. Then the payments made to suppliers. So basically 10 months of my purchases. So 10 into 289 plus the opening trade payables. So this will be 2876. Then the salary. So I've added all the salaries, including the 123 for the salesman. So this will be 867. And then all the expenses, heating and lighting, after the 5% increase was 102.9. And then rent and rates after the 5% increase, 357. And then the sundry expenses. So sundry expenses, this will be 75.6. So these are all the expenses and everything that I can think of. You total both sides and I get 5521. 5521. Right, so my credit balance will be on this side. So this will be 892.5. So this is my closing balance for cash and cash equivalents for the year ended 30th June 2015. Now finally we have to make the statement of financial position. So I'll make it on the question directly because it will save a lot of time. So let me just rub this out and start over for this one. Alright, so plant and machinery, this cuts out and this becomes 520, and this over here becomes 264, and the net book value becomes 256. Then for the motor vehicles, this becomes 370, this over here becomes 224, this turns out to be 146. So you total this up, you get 402. Right. Then the inventory for the year end was 120. Right. Trade receivables. So trade receivables are 440, and you minus 8.8. Let me just write this horizontally. So 440 minus 8.8, and you get 431.2. So 431.2. Your cash and cash equivalents balance was 892.5. You add this up, you get 1503.7. So your total assets become 1905.7. Alright. Equity and reserves. So after another issue of 240, this becomes 250. So $450,000 shares of $1 each. The retained earnings 286 plus 346 for the year's profit. So this becomes 632. You add this up, you get 1082. Sorry for the alignment, it just gets messy. Then non-current liability, yeah, the 10% loan. So I'll add this. The 10% loan will be added. So this will be 100. Another 100 over here. Trade payables. Trade payables were for 538. So just a second. So trade payables of 538 for 2 months, and your accrued salaries will be the commission and the bonus. So 185.7. You add this up as well, you get 723.7. Finally total this up and you get 1905.7, and your budgeted statement of financial position has been balanced. The last part, okay, so we've done this. The last part is explain 2 reasons why a business prepares a budget. So a business prepares a budget to plan for the future, to see if to raise finances, and to make decisions, and to basically evaluate the performance. If the actual performance meets the budgeted performance, if it goes beyond that, if the actual performance actually lacks than what was expected or what was budgeted, to basically have control over the business, over the company, and make decisions correctly. So you just have to explain 2 reasons why a business prepares a budget. So this is it for this entire question. So for all accounts videos, the problem will be that they will be less in number, but they will be quite long because of the extensive working and everything. So this is it. If you have any questions, drop down in the comments below.